All right, so we want to finish up our discussion of the annual statement, the statutory financials. We have Allstate here that we're looking at. And I said last time I really like the 5-year historical data. There's 2 pages of just incredible data back 5 years. So if you're interviewing with a firm like Allstate, and if you can get access to their annual report, the 5-year might be the place you would start. You can see what businesses they're in, not as detailed as some of the other pages I showed you where it gets down to fire and auto physical, but it still gives you a high level of the firm. It shows you how their performance has been over time, gives you a sense of how large they are, just all in one place. So the first thing they give you are the premiums, the gross and net premiums. So we're going to talk about gross and net premiums. Just let me throw it in right here. So gross versus net. Gross is the actual premiums that they've collected. So before any reinsurance. So gross is before reinsurance. And then net is plus any reinsurance assumed minus any reinsurance ceded. So that's gross versus net. With Allstate, you would not expect them to be radically different numbers. So 33,069 and 32.6, slightly different. I'm not sure. I've never actually seen an annual report or annual statement for a reinsurer. You assume with a reinsurer that the gross would be 0 and the net would be the number, but I'm not sure. They may have different accounting altogether. Most of them are not U.S. domiciled anyway. Most of them are in Bermuda or in some territory out in the Caribbean. But for Allstate, it's not a huge difference, but there is some difference. You can also look at the premium growth over time from 28 billion up to 33 billion. Allstate does seem to be doing well. It'll be interesting to compare that to like a Geico or Progressive or a State Farm, just to see who's growing the fastest. This is not a bad way to assess the health and growth of your firm. Then they show you net income. They show you the underwriting gain or loss. So here's where that combined ratio we're talking about is. So you can see they've been fairly profitable, and it looks like 2019 has been a really strong year. Now 2020, with people driving so little, and auto insurance is a big part of State Farm's business, it'll be interesting to see how profitable 2020 will be. A lot of firms, or like we talked last session, a lot of firms are paying special dividends back to their policyholders because auto claims are down so much. But even if 2020 is a good year, 2019 looks like it's a really strong year. The investment gain or loss, you can see that fluctuates quite dramatically. We had a strong stock market last year in 2019. Allstate has in the past hedged its stock holdings. They may not be doing that now. And it looks like with the stock market up so much, they're having some gains there. Also, interest rates were down, so even their bonds were probably producing some realized gains. And then they saw their taxes and then their net income. So you can look at their net income. This is their best net income in the last 5 years, and even double what it was 4 and 5 years ago. Then you get into the balance sheet. You look at the total assets. You look at other assets. You look at the liabilities. You can see how they've grown over time. These can be really, really interesting in a year where you have a major hurricane like we had Harvey a few years ago. You can really see those reserves jump dramatically. Unearned premiums shouldn't be too radically out of line with premiums themselves. They show the net cash flow from operations, but as I mentioned earlier, this is not really a number we use in analyzing insurance companies and banks. They don't really have free cash flows like a normal firm. Now here's the part I do want to get some discussion on. So I'm going to see if I can copy this over. It'd be interesting to see if it will let me copy it over. If not, I'll put it on pause and I'll just put the numbers in. I don't think it's going to let me, but all right, so let me put it on pause. I'll get the numbers in, and then I'll show you what I want you to do with the numbers on the exam. All right, so I took the numbers from lines 28 and 29 and brought them over And so what can we do with these numbers? So there's line 28. It's called total adjusted capital. If you compare this number to their actual net worth, it's very close. It's not the exact same thing. So there is some capital adjusted. So if you actually look at their net worth, come down to page 3, you can see their net worth for this year is 19,111. 19,111. Their adjusted capital is 19,569. So it's very, very, very close. Then the second line is authorized control level risk-based capital. Now, when I was at USAA, I was in a department where we gave feedback to these type of to things like risk-based capital, and we did not like this concept of adjusted control level risk-based capital. But what the authorized control level. What the authorized control level RBC is, it's the risk-based capital times 50%. Essentially, it's 1/2 of the risk-based capital. What the law says is the defined risk-based capital and the defined authorized control level risk-based capital as 50% of risk-based capital. And then they say you're required to have 200% of authorized control level RBC. Well, obviously, pretty obviously that 200% of the authorized control level RBC equals RBC. But that's the way they wrote the law, and we kept asking, and they did it in such a confusing way. They define it in one part of the law, and then they say this in a second area of the law, and you're like, why do you need 200% authorized control level? Oh, why don't you just say you need 100% of risk-based capital? But they don't do that. And their argument is a kind of a strange argument, we thought, but their argument was, if we make it confusing, the media, the financial press, won't know how to interpret these numbers, and we're worried that newspapers and magazines and other people in the media are going to take these numbers and start reporting them. So if we make it really, really confusing, they won't know what to do, and then they won't be reporting this number. We don't want companies getting press about this number because it's a ratio for regulation. That's all we want it to be. And so that's how they wrote the law. We at least twice wrote letters into them asking them to take this whole concept out, but they didn't. They left it in there, and probably 3 seconds after they published all of this, when firms published their risk-based capital, the media went out and did exactly what I'm going to ask you to do on the exam, is take your total adjusted capital and divide it by 2 times the authorized control level. And that tells you we call this the RBC ratio. You've got to be above 1. If you're below 1, if your RBC ratio is below 1, regulators have the right to come in and essentially dictate your business to you. You have to come up with a plan to get your adjusted capital back above your risk-based capital. So it creates all kinds of regulatory hurdles if the RBC ratio hits on 100%. You can see Allstate has not been close. They've been 300% most years, and this year is their best year, which makes sense because they had a really good net income this year. So you can see over time it's been improving. For a firm like Allstate, it makes sense their ratio would be really high. They're a highly rated firm. State Farm's ratio is probably pretty high. USA's ratio was probably in the 400 to 500 range. I can't remember our actual numbers when I was there, but probably a little stronger. USA is a little more highly rated than these other firms. But that's what they do. So on the exam, I'm going to do it just like this. Give you the total adjusted capital, give you the authorized control level risk-based capital, and ask you to give me the RBC ratio. Should be a give me question. All you got to do is remember that the authorized control level risk-based capital is 1/2 of risk-based capital. So the RBC ratio, you have to take authorized capital and divide it by 2 times the authorized, adjusted, boy, I don't know why I keep saying that. So total adjusted capital divided by the authorized control level, RBC, times 2, which is essentially total adjusted capital divided by risk-based capital. Those are the same thing. Sorry, I keep getting these A words mixed up. There's authorized versus adjusted. And it was confusing. They have other levels as well, and you're kind of wondering what the other levels mean. But there are some levels that require the firm to do a plan. There are some levels where they can actually go in and take over the company. And we'll talk about this. This is really important with risk-based capital. With the risk-based capital model law, the goal was to allow regulators to take over a company without having to go to court. So what the law does is it says, hey, if a firm falls below this level, regulators, you have the right to go in and essentially put them into receivership and take over so that they're not, if you have to take them to court, and that's what happened before we had the risk-based capital model law, the only way you could take over control of a firm if you're a regulator is you have to go to court, and that could take months. So now with this risk-based capital law, the second they violate their risk-based capital, the RBC ratio falls below whatever level that is, the regulators can walk in. I'm not sure it's 100% or 100%. That might be where the firm has to do a plan of action to get out. I can't remember the exact specifications. But, and we could find the model law. I think I have a copy of the model law actually on your on Blackboard, so you could get into it. But essentially what we're trying to do is allow regulators to move faster. One of their frustrations was they would see a firm in a lot of trouble, definitely going to be going under. The management of that firm starts rolling the dice because they've essentially already bankrupt. So why not take on a lot of new risk and just hope that things work out, that there's not a hurricane or an earthquake, and just sell a lot of business, a very risky business. And if you end up not having a major catastrophe, you've made all this money and you win. If you lose, you've already lost anyway, you're out of business. And so regulators are saying, we can't let that happen. We need to be able to step in much faster. And so that's what these ratios do, but they try to use trickery to try to hide what was really going on, and they did nothing more than just make things more complicated. But that's what they've actually put into the, and this is the only place in the entire annual report. See if I can get back to the 5-year. Only place in the annual report where they actually show the risk-based capital is on this 5-year. It might be somewhere in an interrogatory somewhere, but this is the only place I'm aware of risk-based capital being there. We can try risk-based, and let's just see where it takes us. So there it is, 1, 2, 1. So here at the end, there's just some questions, and they just answer yes. There's a question about New York. There's a question without the numbers. So essentially, this is the only place in the annual report where you actually get those numbers. But they are available. So if you have your firm's annual report, you can go to line 28 and 29, and you can see what their ratio is. You walk in to an interview and say, wow, your risk-based capital was 322%, the highest you've had in 5 years. They're not going to expect an undergraduate student to know that at all. That would be pretty wild. That might interpret it that you're trying to show off, but that's okay. That's what you're supposed to do in an interview. The next part is their assets, or essentially their investments. The stock line probably should be adjusted, so I actually don't use this stock line. If you look down below, they say investments in subsidiaries and affiliated. You can see their affiliated common stock was $5.9 billion. So a big chunk of this 22% are subsidiaries, companies that they own 100%, like Allstate Life Insurance Company, I would actually redo these ratios. In fact, if I were doing this, I would take the bonds. I'm going to show you I can do this. I would break the bonds up from high quality, medium quality, and low quality. And I would show those three levels. I would want to know how much in below investment grade bonds, the junk bonds this firm has. I would take the stocks and I would take out affiliates, and then I'd look at these numbers. You can make those adjustments, and I'll show you how. So you'd have to adjust these first two lines and adjust the denominator as well. So this is not a great place to look because of the distortion, but it's still there. But if you were going to do that, here's the place you can make the adjustment for affiliated investments. Now, it's really strange that Allstate has affiliated investments that aren't stocks. Most firms, the only line is on the stock line. If you look at USA's property and casualty company, they have one huge number here. It's for their life insurance company, their bank, their real estate company. But for Allstate, they have other, and I'm not really sure what this other is, if it's partnerships or something like that. The next page of the 5-year shows their net worth page. It shows paid losses. This is where a hurricane or a major earthquake would certainly stand out. You have your property lines, liability lines. And this is good because it gives you the breakout between property and liability. And then you have lines that are both property and liability, like homeowners. Here's the paid losses. You can see they're real similar to the actual gross. So this is net versus gross. So on paid losses, these are both paid, excuse me, but on paid losses, gross and net. Remember we talked about reinsurance, so these are gross and net of reinsurance. So you can see how much in reinsurance impacted them. And a year when you have a big hurricane, which might have been this year, right? 2017, wasn't that Harvey? That's when you should see a big difference because Harvey was a big catastrophe. And because of that, and you certainly see a big jump in the property lines, and because of that, they should have gotten a lot of reinsurance. And so there you see, that looks like that's the biggest difference. That's 1.2 billion. I don't see 1.2 billion anywhere else. So that would make sense that would be the Harvey year. They break out, essentially, this is similar to the combined ratio, but not quite. They're doing losses, LAE, and other expenses as a percentage of earned premium. The only one of these numbers that's actually in the combined ratio is other underwriting expenses. Underwriting expenses are divided by earned premiums. Losses and LAE are divided by written premiums in the combined ratio. So I think they show the combined ratio down here somewhere, but I don't see it. So here's, yeah, they're doing some things that there's better ratios that you could develop that aren't in here. And then here below, we talked about the 1-year and the 2-year loss development. So negative, remember, negative numbers are good. You can see that Allstate is predominantly the negative numbers, especially the last few years. And here again, if Harvey was in that year, it would make sense that they over reserved for Harvey. But anyway, just want to let you know, man, the 5-year historical gives you some really, really great information. So there's the 5-year. I'm going to flip back to my shorter version. What I wanted to show you here on this page, it's a little hard to see, but these are called the state pages. And what's interesting is they essentially do this almost, it's hard to read these numbers because it's really blurry. See if I can find it in the other one. So I'm just going to search for the word Texas. And there's 105, so I'm not going to do that, so forget that. Business in the state of, let's see if I can find, well, I don't know if I can find, well, anyway, it's just going to be blurry. But essentially what you're doing is you're getting detailed information on premiums and losses at the state level. So the state pages, that was something new when I was at USAA. They did not have state pages when I was in the accounting area. But they do now, and it's really interesting. You can get a lot of really, really cool information there, especially after a major hurricane like Hurricane Harvey. These pages can be really, really interesting. And then exhibit of premiums. So I'm sorry, this is the same thing. Exhibited premiums and losses. It's the same thing. I just blew it up. So sorry about that. I forgot that I did this. So it's the same page twice. Just at the bottom, I blew it up so it's a little easier to read, but it's still blurry. So if you want to find this in the actual annual report, you'd have to search on keywords on this page to find it. And then Schedule P, we've already talked about Schedule P, so you should be good on Schedule P. Only thing I want to show you on Schedule P, these are the schedules we were using in our exercise. What I want to show you though was that they do Schedule P at the product level. So they have Schedule P for homeowners. They have the Schedule P Part 2A and 2B and 2C, all those different pieces. They have it for homeowners. They have it for private passenger auto liability. They have the 3A. Remember, the 3A is the paid losses. They have that for homeowners. They have that for private passenger. Another exhibit that I think is really, really interesting. This video is running a little bit long, but Schedule T, where I would encourage you on Schedule T. I tell you what, let's break the video here, and then at the beginning of the next session, I want to show you Schedule T. It's another very important schedule if you're interviewing with these firms. It'd be a really good schedule to look at because it'd be really eye-opening, especially Schedule T and Schedule Y. Those are the last two I want to show you in this class. And we're getting close to the end of accounting.